Strong show by the markets, now up about 0.7%. So good going really for almost all the companies. What's not, or for the markets at large, what's not doing well is Cipla. It's had a tough time in the second quarter with numbers missing estimates. But what's a bigger worry are the headwinds listed out by the drug maker for the rest of the year. Darshan Mehta caught up with the company's Global Chief Financial Officer Kedar Upadhye and started off by asking him what went wrong in the second quarter.
If you recollect, last year's September quarter, the Q2 of last year had a higher base. We had a higher base in domestic business because that was a quarter after GST implementation. So we had a restocking benefit last year. Emerging markets and API also had a higher base as well. So I think we are starting this year on that higher base of last year. That is one. Secondly, in terms of capacity and supplies and overall serviceability, to various markets, we had certain deficits. So that was more an internal miss that we have to address. But I would say that, if you dissect various geographies, the private market segment, which is excluding the tender market segments, be it for emerging market or South Africa and other territories, private market segments did well. In fact, we improved our ranks, our growth continued, and overall EBITDA because of that held as well. So, for the quarter, we have reported 18.8% of EBITDA, which is among the peer group one of the highest. And that was on the back of 18.4% EBITDA for the first quarter. So I would say that our spend controls continued, private market performance across various businesses continued. The launches in US have gone well. Overall, the US revenues have seen only about $8 million increase compared to quarter one in local currency. However, the DTM performance is much higher. This 8 million increase masks a little bit of a decrease in the B2B segment. So if historically we were present in US through our partners, and those historical relationships are seeing a little bit of an erosion, both because of pricing by our customers in the market, as well as the fact that we are not seeding new molecules in the B2B segment. So I think B2B segment is declining, and the increase in DTM is much higher than what we are seeing at overall US level. So on the whole, yes, overall the numbers might appear to be a little modest, but we are happy that our performance in the private market, which is what we could influence and which is what we could drive at, along with that spend controls and overall profitability, at 18.8% EBITDA for the quarter has been demonstrated in this quarter.
So I'll take you on these factors. So first, let's take first of all supply chain issue. If I'm not mistaken, this is not the first time that Cipla is facing supply chain issues. It's an internal thing. Why aren't you able to get this right?
No, so we are getting right, plan by plan, product by product, and line by line. I think there are some of these factors are a little longish for us to attack and overcome. And we have to do this in the FDA CGMP environment, as you would know. That's why I think it's always better to take time and correct it after doing appropriate root cause analysis. And we are on it. And I think it's a matter of just 1 or 2 more quarters. And if you look around in the industry, every company which has scaled up its presence in US, I think it sort of goes through some of these issues. Sometimes you get approval, but you are not able to launch. Sometimes you launch, but you are not able to repeat the service order. And that happens because of a variety of the factors, which will be difficult for me to go into details now. But to answer your question, I think it's a matter of next couple of quarters, and we'll be able to overcome these issues.
Okay. Secondly, on the margins, now you've had margins of close to 18%, and it's been a while since you are in this range. I distinctly remember, my earlier conversations with you, my earlier conversations with Umang, that you all said that gone are the days when margins used to be 25, 30%. The new normal is 21%. Now you're not even getting 21%. You're coming in close to 17 to 18%, and that too for a company which has a lot of branded business. So is that not something investors should be concerned about?
Yeah, so I think the EBITDA for this quarter, Darshan, is about 18.8, so very close to 19%. And we could always be higher than that. I think some of these supply issues caused that little bit of deficit contribution. In case we did not have some of those issues, would have been higher, obviously, and margins could have been higher. But we are at least in that zone compared to 13-14% base business EBITDA which we were in 2 years back. I'm happy that we are in the zone. We are not far away. I think at this stage we'll have to balance both profitability and growth. In fact, cost decrease led EBITDA expansion. I don't want to say that it's over, but I think what we need now is both growth and profitability balance. That's why you saw, we are investing in, a campaign, which is a flagship, inhalation awareness campaign called as Berok Zindagi. And that in the short term obviously creates some pressure on the cost, but I think it's the right thing to do. So what I'm trying to tell you that, in the coming days, we will balance both profitability and growth. Reported EBITDA for the quarter is about 18.8. And we are happy, with the expansion of the US DTM business. In fact, you alluded to the branded market mix being higher for Cipla, and that's true. Most of our cash flows and valuation today comes from the branded markets, and we are investing in the US market. At the current scale of the US revenues, US business is not fully broken even. So when the US revenues inch up more towards 120, 125 million towards the end of this year, that would be the quarter to watch out for, in terms of the break-even of the US business. And then subsequent to that, once US business incrementally starts contributing to profits, I am quite sure that there are opportunities for margin expansion. But what I'm happy is we are not far away from the accepted zone. And while we could always be in that zone or higher, I think, as I said, we'll have to balance now growth and profitability both.
Okay, coming to the US business, you all had several launches this time around. The base compared to the other pharmaceutical companies, your peer group was much lower. But nevertheless, the US business ramp up somehow doesn't. You all showed a growth, I'm not denying that. But somehow that ramp up or the expectation of growth is somehow is not coming in. The growth is simply not there for the US business.
Yeah, so Darshan, let me just give a perspective. I think that growth is there. See, our US business comprises three segments. One is the acquired Invagen business. Secondly, the B2B business, which are the historical partnerships that we have signed over several years. And third is the DTM, the direct to market piece, where we launch our own NDAs. And in the 2 years from FY 17 to 19, the DTM part, which we could influence and which we are working on, is reached almost 200 million on an annualized basis. And I'm quite happy because it started at only 40 million in FY 17. So from FY 17 to FY 19, the DTM piece has scaled up from 40 million to 200 million. So that's the growth that I think you and investors are looking for. What has happened at the same time is the B2B piece, which is the historical relationships, are coming down, and the rate of decline of that B2B business was probably much higher than what we anticipated for. And that's why at an overall US level, you are not able to see traction. While there is a traction compared to first quarter, we have grown compared to last year, first half, this year, first half is also we have demonstrated strong growth. However, it could always be higher, but I am happy that the DTM piece which we could influence is grown. A part of that growth has been masked by the decline in both the B2B and Invagen business, but I think some part of that decline was by design. And going forward, as some of these launches that you rightly said are some of the most important launches which have been made in the recent couple of quarters, as the scale up in terms of their share and their contribution to revenue, you could see additional impact.
Okay. The other, I think, point of contention, and which actually today spooked the street, was the challenges that in your investor presentation you put out. There are some challenges that you believe will come in the next 2 quarters, be it the sanctions, be it capacity balancing, commodity crude price and China issues, and pressure on the tender business across the markets. Am I supposed to read that the second half probably won't be attractive or probably will not perform as well as you did in the first half?
Yeah, Darshan, I thought you would make a favorable comment on Cipla because of those comments. I think we are always in favor of being very open and transparent about the challenges being faced by the company, and that's in all fairness and in all transparency, we made that communication. That is one, but I think your question is important. What we also said on the earnings call that was recently concluded, today, that the absolute level of profits probably we won't like to see too much of a decline. There may not be too much of an increase as well. Quarter 4, there is a seasonality, reverse seasonality in India. So India revenues typically go down while US revenues will go up in quarter 4. But that was an attempt by us to be transparent with investors and media. Every single point alluded to in that particular slide is genuine, and it's impacting In fact, not only Cipla, because sanctioned countries or tender business environment, some of these things you're seeing in our peers as well. So I think some of the factors mentioned in that slide are more generic and at an industry level issues. Supplies is a internal thing which we have to get back on track. But I think the attempt was to be very open and transparent with media and investors.
Kedar, my point is
our efforts to mitigate those factors continue.
So no, Kedar, it's not about being fair on this thing. I give it to you that you all were forthcoming enough to put these factors on this thing. My only thing, and what I want to ask is that because some of these concerns seem to suggest that there could be some bit of issues that could impact the financials. I'm not judging whether you did the right thing or the wrong thing. It's fair. What you put out is fair. That's your assessment. I'm just asking, based on what I am reading, can I expect second half to be tougher than the first half? That's a simple question.
I think it will be tougher for those issues which are listed down. For example, if the sanctions announced by US go through completely, whatever contribution is there in Cipla today because of those sanctioned countries will face a challenge. Similarly, we alluded to other geopolitical issues and inability to effectively participate in the tender business because of the constraints on the funding environment. So to the extent those funded tender businesses contribute to Cipla's top line and bottom line, we will face issues. But that does not mean entire company is clouded by that. I think those are selected 2-3 items which we felt it's appropriate to communicate in all openness and transparency, and we have spoken about it. Our work on private markets is cut out. Our work on costs is cut out. Our work on making robust filings in US, our work on ensuring that the important limited competition launches which you have filed, ensuring that we get to a fair share of the market there, that is cut out. So I think we'll continue the progress on identified areas of priority, and I think beyond our effort to be transparent with investors, you shouldn't read too much into that slide.
We leave it at that. Thank you so much for joining us and being candid enough to answer the questions that we've posted to you.